Hello there and welcome to the UK Equities Week Ahead for the 17th of March, the week starting 17th of March. So the main focus this week will be the Bank of England interest rate decision. However, there are a couple of earnings from key companies to be watching out for, major companies, including Travis Perkins, Prudential, and then Carnival, and also Wetherspoons at the end of the week. So let's just kick off though with an update with regards to the Bank of England, what we're expecting there, stocks to watch, etc. So Bank of England expected to leave interest rates unchanged at 4.5%. The interest rate decision comes after the Bank of England cut rates in the previous meeting by 25 basis points in a decision that was more dovish than what was expected, with two policymakers voting for a 50 basis point rate cut rather than the 25 basis point rate cut. Now, because the market is completely expecting the Bank of England to leave interest rates unchanged at this meeting, the focus is going to be very much on what the statement says and the outlook from policymakers as far as growth and inflation is concerned. Inflation has ticked higher to 3%. We've also got the growth was cut. Growth contracted, in fact, in 0.1% in January month on month. Bank of England also slashed their growth forecasts in their latest projections. And they also see inflation ticking up 3.7% in Q3. So we are very much looking at sort of a stagflationary outlook, which means that it makes it difficult for the Bank of England to be cutting interest rates, given that inflation is expected to remain sticky. But at the same time, there is little risk of the UK economy actually overheating. Now, what does this mean as far as stocks are concerned? There are obviously certain stocks that we're going to be watching quite closely around the Bank of England interest rate decision. Banks would be ones that I would be looking at closely. Here I've got Lloyd's share price chart up, but also consumer discretionary stocks could also be hit if we hear of a more cautious tone from the Bank of England. But let's just have a look at, this is Lloyd's, as I mentioned. Now, interestingly, Lloyd's had risen to its highest level since the 2008 financial crisis. That was just early this month, but we have seen it fall away relatively sharply, just coming down to this level here, which was 66.80. Now, again, if we hear about concerns over the outlook for the UK economy, particularly given the trade concerns, with global trade concerns, then this could see Lloyd's fall further. But if we do see that the Bank of England are actually relatively upbeat and not terribly concerned about the outlook, at least for now, then that could offer some support to Lloyd's, helping it back towards this key level here, which is the 74.75. That's the level that buyers are going to need to rise above in order to create a higher high and head towards the 80p per share. As I said, these are levels that were last seen in 2008, around the 2008 financial crisis. If for whatever reason we see a break below that level down at 66.80, that opens the door to this one here, which is around the 63.50 mark, which was the high that we saw in 2024. So that's Lloyd's. Other ones to be watching out for, as I mentioned, we've also got some earnings from Carnival. This is the just bear with me. Here we go. The Carnival, this is the cruise liner company. So basically, they're going to report results on Friday. These come after an incredibly strong finish to 2024, which saw record revenues of a high of $25 billion US, whilst underlying profits were also recorded at $6.1 billion US, 40% higher than a year earlier. Now, Carnival also forecast that the quarter that they'll be reporting on now, we're expected to see income of $2.3 billion US, up 20% from the same period a year earlier, and margins, with a 4.2% increase in yields. However, we're going to watch out for what they say as far as the outlook is concerned very closely, because if we have a look at this chart here, we have seen that the share price has tanked since February, and this is basically amid concerns over the outlook for discretionary stocks, travelers. We've seen the same with airlines in the US, because of concerns over the outlook for the US economy and the potential impact of Trump tariffs on the US economy, what that might mean for the US consumer. We've already seen that the consumer confidence has fallen, business confidence has fallen, and that's what's really affected the outlook for the stock near term. So it'll be really key to see what management say about this. Now, as we've said, we've fallen from this level here, 2086, and we've fallen all the way down to 1,300, basically, taking out all the SMAs. We have steadied at this level. We're deeply oversold, so we could see some price consolidation around these levels. Any recovery will first need to make above that 200 SMA around the 1,490 level in order to sort of build a recovery. But we've got the 50 SMA crossing below the 100 SMA there in as a bearish signal as well. So sellers on the downside, if they get a break below that 1,300 level, then that could see deeper losses towards the 1,150 level, which was the low we saw back in October last year. Other one just to be watching out for, JD Wetherspoon's also reporting on the Friday. Now, this, let's just have a look at the weekly chart here, but let me just fill you in some details first. The pub chain JD Wetherspoon's will release its half-year results on Friday, as I said. In a second quarter update, which was released in January, Chairman Tim Martin reiterated concerns over the labour costs, which are expected to increase to 60 million a year as from April. Now, this comes, and I mean, we've had many UK businesses warn about the impact of the increase of the minimum wage and the increased employers' contribution for national insurance, as was announced in the Labour market, in the Labour government's budget in October last year, expected to have a big hit on certain industries, and pubs are expected to be one of those industries. Now, they didn't also increase, JD also posted a 5.1% increase in sales compared to the previous year, which was encouraging. We were expected to get more details of those in the half-year results. Profitability and cost control are going to be the main focus, given those concerns over increased costs that are coming through. And that'll really give some clues over whether the pub chain will be on track to reach forecasts of 2.7% increase in operating profits to 143.3 million this year. Now, as I said, just having a look at the chart, this is the chart. It's trading down. This is a falling trend line that has been in place since 2020. So that's the start of COVID. We can see that falling trend line very much in play. We're just testing this level here, which is around the 575 level, the low that we saw October 2023. So we're trading around the lowest levels that we've seen for quite some time. We got a break below that, look at 387 as the next level on the downside. If we do find that this support holds around the 575 level, the recovery is going to need to, first of all, take over 660, 670. That's that falling trend line. Then we've got the 200 SMA around the 725 level. Really, we're going to need a rise above the 838 to get a higher high and for the structure of this to change, the structure of this chart to change. So I hope you've liked everything that we've discussed, and please do give this video a like and join us next week.